Hi guys, welcome back. Most investors think analyzing a trust is just like analyzing any other company. But that's a big mistake. Investment trusts play by a completely different set of rules, with their own metrics, risks and rewards. Today we're cutting through the complexity and compare 6 of the UK's biggest renewable energy trusts. Some are offering massive 12% dividend yields, while others are quietly trading at discounts of more than 30% to their net asset values. But does that make them bargains or dangerous value traps? Stick around, because by the end of this video you will know exactly what matters when investing in renewable energy trusts and which of the big ones I would choose. And if you're new here, my name is Florian. Thank you for joining me today. The 6 trusts we'll compare today are the Renewable Infrastructure Group, Foresight Solar Fund, Foresight Environmental Infrastructure Fund, Next Energy Solar Fund, Octopus Renewable Infrastructure Trust and Greencoat UK Wind. All of these trusts are currently experiencing tailwinds from the net zero goal that the UK wants to achieve until 2030. This has already led to a big jump in permissions that are being issued for building out the renewable energy capacity. But new projects are only the tip of the iceberg, because the technological advancements in this area that are currently being implemented will also lead to a higher efficiency for older parks. So there is a lot of potential here. But before we jump into the detailed comparison, I'd first like to talk how to analyze UK investment trusts in general. Because even though many and especially newer investors think that all companies are growing in the same way and need to be analyzed in a similar manner, this is actually not the case. And UK investment trusts are no exception. If you are already familiar with how these trusts work and what metrics to look for when analyzing in them, please feel free to directly skip to the comparison by using the bookmarks below. I would still recommend you watch this, because there might be some info here that you haven't heard yet. And I also prepared a short checklist that shows the main differences between analyzing an investment trusts compared to a regular company that you might find helpful. But let's start at the beginning. UK funds in general were founded to bundle the money of investors and give them the possibility to invest in things that would otherwise be hard to invest in as individual investor. They are managed by a fund manager who makes the investment decisions and is usually focused on a specific topic, like a special kind of properties such as hospitals or wind parks, or even other assets like debt or insurances. Not every company can become a trust. There are special rules that need to be met in order to qualify as a trust. The first rule is that all of the business of the company must be to invest its funds in assets with the aim to spread the investment risks and give its member the benefits of the results of these investments. The second rule is that the shares of these trusts need to be traded on regular markets. And the third rule is that the trust is not already classified as REIT or VC trust, which are actually pretty similar to trusts. When these criteria are met, an investment trust does get special and favorable tax rules. But in order to get this, they are also not allowed to retain over 15% of its income and must distribute the rest of the money as dividends. So in principle, they are very similar to REITs, although there are some small differences in the operating details. Investment trusts bring some advantages when it comes to investing. First, they offer a wide range of investments, also some that are not so easy to access as individual investor. And because they spread their investments, they are inherently diversified, at least within the range of the designated topic. This makes them a bit less risky than individual shares. They also use external industry experts to manage the portfolios, who bring their own set of expertise and connections that can also help to make good deals and boost the performance. And they can also use gearing or debt to further boost the performance, which is absolutely not recommended for individual investors. But this gearing, of course, also introduces some risk. And the higher the gearing, or in other words, the higher the percentage of debt a trust takes in relation to the value of its assets, the higher the risk. And because the shares of a trust are traded on regular markets, their prices can rise and fall in value as every other company that is also publicly traded, and many factors can affect their performance. And because of this volatility, the market capitalization of a trust can be different to the value of the underlying assets. If the price is cheaper, a trust is traded at a discount to its NAV or net asset value, and if the market cap is higher than the assets, it is trading at a premium. Most trusts actually trade at a discount to the NAV most of the time. But this depends on many different metrics like the perceived quality of a trust manager or the market sentiment, and can also change pretty quickly. So, an investment trust is not a regular company and should not be treated like one. They are rather listed investment vehicles that pool the money to access often hard to reach assets. But that also means that when analyzing them, we need to look at different metrics than for regular companies. I tried to sum up the biggest differences in this table. Let me explain. First, we have the difference in their business model as I just explained. While regular companies earn their money by selling products or services to their customers, trusts earn money by investing in assets and generating cash from them through dividend or interest payments, or through selling the products of these assets, like power in our case today. And while the relative valuation of regular companies is measured in multiples, such as the price to earnings, enterprise value to EBITDA, or price to cash flow, in case of a trust, these values are pretty much meaningless and it makes no sense to look at them. Instead, it is much more valuable to analyze the net asset value, how it developed over the last years, and if the current market cap of the fund is trading at a discount or premium to its net asset value. Another important metric to look at is the so-called look-through cash generation, which is basically the cash generation of the assets after paying the interests and amortization costs and after deducting the management fee. It is basically the money that a fund can use to pay dividends, buy back shares, or reduce debt. The leverage, or in the case of a trust, gearing, is also measured a bit differently. Here we look at the debt from the fund and its assets, which are sometimes also called SPVs or special purpose vehicles, and put them in relation to their GAV or gross asset value. For regular companies, I like to look at the net debt to EBITDA ratio and the interest coverage here. And while the key KPIs for analyzing regular companies include their growth in revenue, EPS or free cash flow, the margins and return of invested capital, CapEx strategy, and also the market position and mode, for funds, it is mostly the net asset value total return and discount or premium to this, their gearing, management fees, dividend cover, and inflation hedges. So now that we know what to look for in a trust and what the key KPIs are, let's compare our renewable energy trusts. And let's start with the Renewable Infrastructure Group with the ticker TRIG. They are operating all over Europe, although 60% of the assets are in the UK. From these assets, onshore wind parks make up the biggest part with 47%. But the trust is also diversified over several different assets, like offshore wind parks with 33% and even solar with 14% and 6% what they called flexible capacity, which are basically battery storages. What I like about TRIG is that they have fixed around 70% of their revenue for almost the next 10 years. So the majority of their revenues are very predictable and stable. At the moment, they have a portfolio gearing of 38%. And by systematically paying back debt, they expect to lower this over the course of the next few years if they don't take on any major new debt. It is sometimes a bit intransparent of how exactly the company calculates the gearing in their presentations. So when we compare the companies later, I will use the gearing that the AIC calculates because they use the same calculation for all companies. So don't be surprised if this number is a bit different to the one in the reports. The AIC states the gearing as percentage of the net assets. For TRIG, this number is 12%. And here we also see that they are paying a pretty nice dividend of almost 10% to their shareholders, and that the trust is trading at a 30% discount to the NAV. But unfortunately, the AIC doesn't state the dividend cover on their page, which in the case of TRIG is with only one time pretty tight. So there is not much room for error. But the average cost of debt is with 3.5% pretty low compared to some other trusts that we'll come to. This leaves them either more cash left over to pay their shareholders or enables them to take on more debt than other trusts for the same costs. Next, we have the Foresight Solar Fund, FSFL. They are the only trust of our comparison today that has a significant share of the assets outside of Europe, namely 17% in Australia. Further 8% are in Spain and the rest in the UK. And as the name implies, they are only investing in solar power and battery storage. A good portion of their revenue is fixed revenue coming from subsidies and fixed electricity sales. But the contract terms for them are much shorter than the ones for TRIG. So the portion of fixed revenue will go down significantly next year. They have a total gearing of 39% and the cost of their debt is with a bit over 4%, around in the middle of our companies, but still around 0.5% higher than the one of Trig. And now it becomes apparent why I used the gearing numbers from the AIC instead of the ones from the company reports. Because even though the gearing looks similar at first glance, the AIC reports a much higher NAV gearing of 74%. But at least they are also paying a large dividend of close to 10% and are also trading at a discount to NAV of 24.8%. The large dividend is still covered reasonably well, and with a dividend cover of around 1.3 times, it's in about the same range as most of our other trusts in our list today. The next trust is also managed by Foresight, and it's the Foresight Environmental Infrastructure Trust, FGen. Together with ORIT, they are probably the most diversified of our trusts today and operate over three major pillars. The first one is the renewable energy generation that makes up 73% of their assets. But even within this pillar, they are pretty diversified over wind, solar, biomass, and even a little bit of hydropower. But they also have 10% of their assets in power storage and transport and another 17% in resource management. Almost 89% of the assets are in the UK, where they also put their main focus. The remaining 11% are in the rest of Europe. At the moment, 61% of their revenue is recurring revenue, but this will also fall in the next years. But because the business is much more diversified than the one of most others here, they are a bit less exposed to the energy prices, which are expected to generally fall in the next couple of years. So this is a good thing. They state a gearing of 28.7%, which was even reduced compared to last year. And they even state here that this is one of the lowest in the industry. What is not the lowest in the industry is the cost of their debt. When we look at the total debt again, including the short-term revolving credit facilities, the cost of debt is with 4.9% pretty high. The gearing, as reported by the AIC, is at 24% of the net assets, and their stocks are also trading at a discount to the NAV. Currently, this discount is at 27.6%, and with a huge dividend yield of over 10.5%, they have the second highest yield in this comparison. And this yield is also covered pretty well by 1.3 times. Next, we have the Next Energy Solar Fund, NESF. Similar to the Foresight Solar Fund, they are also focusing on solar parks and battery storages. But they go even more all in on solar than FSFL does. 97% of the assets are solar parks, while only 3% are battery storages. And as usual for these UK trusts, most of the assets, namely 84%, are located in the UK, while the rest is split all over Europe. For the running fiscal year, 89% of their revenues are fixed. This is pretty high and gives them a nice predictability of their cash flows. But because they are fixing their PPAs on a rolling 36 months period, this is also going down to around 60% in a couple of years. But when we consider that this is the value that some of the other companies have fixed today, it is still not too bad. They state a total gearing of 48% right now and a dividend cover of 1.1 times. So from this point of view, they are one of the riskier trusts. But this risk is also avoided with the highest dividend yield of over 12%. Unfortunately, this high gearing also comes with significant costs. Because their average cost of debt is close to 5%, one of the highest values in our comparison. Unfortunately, the numbers don't get better when we look at the calculation from the AIC. They even state a gearing as percent of their NAV of 101%. This would mean that they have more debt in their books than their assets are currently worth, which is a huge red flag for me. With these numbers, it is even surprising that they only trade at a discount of 27.4% to the NAV. Because this video is already pretty long and it took quite some time and effort to gather all this info, I could not dig too deep into the reasons for this. So if you're thinking about an investment in any of these trusts, and NESF especially, please do your own research and see if there's more going on. Because the numbers don't paint the full picture, but the part that they paint doesn't seem to be too rosy. And that brings me to our second last trust today, which is the Octopus Renewables Infrastructure Trust, or ORIT. They claim to be the only real diversified investment trust in this space. And when we look at the business mix, this might as well be true. because they are indeed pretty diversified in countries as well as technologies. With 43%, the majority of the assets are still located in the UK, but this share is far lower than our other trusts today. And with an almost 50-50 split between wind and solar, their technologies are also nicely split. Unfortunately, their gearing increased quite a bit during the last year, and their total gearing is sitting at 45% of their gross asset value. This is also one of the higher values of our comparison today, as we'll see when we look at the AIC numbers, but the company has also already recognized this and wants to reduce it below 40% next year again. Despite this, the dividend is still covered pretty well by 1.2 times. This is also impressive because they sit at a current yield of 9.2%. What I like most about them is the large amount of fixed revenue that is at 48% right now. And in contrast to all other funds, they expect that this portion will even go up in the next years. And at the same time, they could just lower the cost of debt from 4% to 3.7% with a new debt facility, which will also help them to not only manage the income, but also the debt payments. The gearing as calculated by the AIC is at 84%, which is the second highest value. But again, the company is already making some efforts to lower this. At the same time, their shares are currently trading at a discount to the NAV of 32%, and the company is paying a dividend with a yield of 9.2%. And that brings us to the last company today, Greencoat UK Wind. But don't think that we are already finished, because there are many numbers and metrics to digest. So to make it a bit easier, we will also look at the comparison table with all the metrics that I have prepared. But first, Greencoat UK Wind. As the name implies, they are only operating wind farms, but at least they split pretty evenly across onshore and offshore farms. And all of the assets are located in the UK. For them, 60% of their revenue is fixed revenue. This is also fixed and inflation linked for the next few years until 2029. Their gearing to gross asset value sits at 41%, which is pretty reasonable. And the dividend with a current yield of 9.7% is also covered with 1.4 times right now. Unfortunately, the cost of debt is with 4.6%, also rather on the higher side of our companies. According to the AIC, their NAV gearing is 35%, which puts them roughly in the middle of our companies today. And this gearing comes with a NAV discount of 25.7% and a dividend yield of 9.7%. Greencoat UK Wind is actually also the only renewable infrastructure trust that I already made a full analysis about. So if this sounds interesting for you, I'll leave the link to this video in the description below. And before we sum this up and come to the comparison table that I promised you, if you like the video so far, I would really appreciate it if you hit the like button and subscribe to the channel. As a small channel, this really helps me out a lot and it really makes my day. So thank you very much. And that brings me to our comparison. Here I listed all these companies with the key KPIs against each other. In addition to all the metrics we already saw, I also stated the 5-year NAV total return here. This shows the per share NAV change plus dividends reinvested at net asset value. So it leaves out the market sentiment, the discount and premium to NAV, and gives a very clean read on the portfolio return. The total share returns are basically the NAV total return plus the discount change. So these NAV returns are very valuable when comparing trusts with different discounts, buybacks or liquidity. And from this net asset value total return point of view, UK Wind and Foresight Solar had the best performance by far, while the other companies are roughly on par. Now, you probably want me to give a recommendation and say which of these trusts is the best one. And I want to be totally honest here. I find this hard to do without digging deeper into all of them. I know, this is probably not the answer that you want me to give. So let me tell you at least which one I like most based on what we saw so far. For me, the purpose of such a trust would be to provide a long-running and stable passive income in forms of dividends. So I would choose one that is diversified, has a reasonable gearing at low cost, and a good dividend cover. Or in other words, I would choose safety over maximum potential returns here. And Octopus Renewables looks like a good candidate. Their low cost of debt makes them pretty safe, and their large amount of fixed and returning revenue gives them a great predictability. But again, This is no financial advice, and before investing, do your own research and see if there are any other hidden dangers. Now, there are a couple of things that I have not mentioned yet, but that are relevant for all our companies today. And because I know that someone will mention it in the comments, let me briefly go over these things. First, the power price development in the UK is going down. This is in every single report from all of these companies. Here, the example from Trig. This will put pressure on the cash generation from all of these companies and make it even more important, at least in my point of view, to have a good portion of fixed revenue. Another thing I want to mention is that the inflation in the UK has just jumped again. This can have effects on the NAV valuation, the dividends and the revenues, and make it even more important to have CPI-linked revenues. And last but not least, even though the permits for renewable energy projects have vastly increased, this doesn't mean that all of them will be realized. And the headwinds are mounting, with the first projects even being cancelled due to high costs and missing specialists. So the situation is pretty complex, and even though there are headwinds and huge chances for this industry as we saw before, the last words have not been spoken. But that's just how I see it. What do you think about the industry, and which of our trusts today do you like the most? Drop your thoughts down in the comments. I would really love to hear your opinion. And if you would like to dig deeper into the details of Greencoat UK Wind now that is currently paying a dividend of 9.7%, check out this video right here. And as usual, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys, and see you in the next video.